All right, just want to answer a couple of questions I got from members Sweet Bobby and Shaolin Monk here. Sweet Bobby, still wonder if you're still wondering if legging into the Iron Condor will increase our P&L. I don't know if it's going to increase your P&L. Um, you shouldn't even look at it that way. If you're going to be legging into an Iron Condor, you're not really doing an Iron Condor. You're doing a vertical spread on one side and a vertical spread on the other side. So in that case, treat them as separate events. Um, and you use the probabilities. So I don't think it makes a difference. Enter one in with whatever 84% probability of finishing out the money, and manage that. So if it gives to 70% out of the money, move it on. Do the same thing for either side. You can do it that way as well. I got another email from Shaolin Monk. He had a bunch of questions here. So Shaolin Monk is bearish on the market. He thinks that by January 2015 it'll be lower than it is now. Um, but Shaolin Monk, just to answer your questions right here, you are 100% correct on all of them. I think you asked here, what's the main difference between weekly and monthly options? Just that time frame. But usually the weekly doesn't have as much IV, right? As much volatility, so you usually can't sell as much premium. But they're helpful if you want to, manage your positions within that same month, and you don't want to stretch it out to the next month. For example, Karen does that because she manages people's money. She has to monitor her returns on a month-to-month basis. So she tries to wrap up everything by end of the month. But if you're not managing other people's money, you can stretch it out to the following month. No big deal. Question 2 and 3, you're correct as far as when you make money. This right here is the main disadvantage on buying puts. Okay, when you buy an option, no matter what, right, you have to pay for it. So this actually raises your cost basis instead of lowering your cost basis. So you're right. If you purchase the $200 put for $2 each, your cost basis is not lower; it's higher. It's at 202. So, uh, well, I'm sorry. I apologize. Depending what you're buying, if you're buying a $200 put, that means you are betting that the SPY will be below $200. Okay, but that means because you bought that $200 put, it has to drop $2 for you to make any money. So that means for you to make any money, it has to drop below 198. Okay, because your cost is $2. For you to make a penny, it has to go below 198. Okay, because you're buying it. Why are the $200 so expensive? I have no idea why, but your math here is correct. If you buy the 235 put, if you buy a put, that means you're betting that the SPY will be below $235 at the end of expiration date, and I think this is January 2015. You put there. So yes, if you buy the 230 put for $41.90, when you buy a put, you have to pay the asking price, which is $41.90. So he is right. $235 minus 41, actually 41.90. But you get the gist of it here. You have to for you to make any money, the SPY has to be below 190. Below what you paid for it. So 235 minus the 41.90. So that's the big disadvantage of buying puts. So if you look over here, I'll go to the SPY here, go to the trade page, and let's go to the January. So he believes that by next year, in 82 days, the S&PY will be lower than what it is now, which trading right now for 196.43. So if you look here, okay, if he's gonna buy the put, so he wants to buy this put. Where is it? 235. Okay, see right here, he wants to buy this put. So if you buy a put, he has to pay $39.63 for it. Okay, at the present time. So let me get out my calculator here and watch. I'll go real quick here. So it's two. You got so what you got? Where do you start making money? You have to take the $235, the strike put price, and you have to subtract, okay, $39.63. So 235 minus $39.63. That means for you to make any money, okay, the S&PY has to finish below 198.37. Okay. Now, what are the chances of that? Okay, you can do it in one of two ways. You can go into DOE. Watch this. You can go to DOE. You can go to option here. long means you want to buy an option. A long call means you're buying a call. That means you're betting it'll go up. A long put means you're buying a put. You're betting it'll go down, right? So I'm just going to hit go here and just move the expiration, right? So all I'm going to do is you can just double click this. Go to your expiration date. We're going to go to January right here. Regular. R means regular, right? Okay. And then we can click done. And then you want if you're buying a put, you want to bet that it'll be, he said 235. So you can drag it up here to roughly the 235. Or we can double click this and here, strike this here, type in 235. Okay, and hit enter. There we go. Click on done and I'll zoom out. Okay, so where are we? Here we go. So here we go. So you're buying this put. Your chance of being right is about 48%. Okay, look, the green is where you make money. So what that means is it's at 196.60. If it finishes anywhere above, well, hit the show button here. If it finishes, you only make money if the SPY ends up less than 195.37. So it has to go lower than it is now at the end of January. Okay, and if the price of the SPY winds up being greater than, so anything above 195.37 is where you lose money. Okay, so right now you're going to lose money. So this is the point. Now watch this. So that's your probability of making a profit. So the other thing you could do is look at the difference if you sell a call. All right. So what I'm going to do here is I'm going to grab a call and, I'm going to go to strategies. I'm going to go to options. I'm going to go to short call because we're selling a call, meaning we bet it's going to go down. All right. We're going to double click this and we're going to change it to the same expiration date as before. So we're going to go to January and we're going to change it to 235. Okay. Because you're betting, you want it to bet it'll be below 235. Okay. So done. Well, look, you can't even collect any money because it's such a good bet. So watch what happens as I lower this down. See this strike right here? I'll lower it down to the 2. Now, the reason why it's like that is because anything over 2 standard deviations is what the I guess the brokers or whatever, they consider that as a black swan event. The probability of happening is less than 2%. Okay, so that's where they consider unlimited risk. So watch as soon as I drop it below right here, you only can collect 2 cents. Why? Because you have a 95% chance of being right. Because you have such a high probability of being right, no one wants to buy this from you because no one, they have a 95% chance of being wrong. They only have a 5% chance of being right. That's why that put that you were going to buy costs so much money. Okay, because you have such a high chance of being right, they want you to pay for it. All right, so this is why you can't even sit. Now look at if I go to the chart here, look, 235 strike price, right? If you're selling it, you can sell it for $39.14, right? Which ain't gonna happen though. Watch this. Well, that's in the money though. Okay, so we never sell in the money puts because it ain't. You know what I mean? So what you want to do is you want to sell the I'm sorry. We could sell the call. So let's sell the call. Look, if we sell the call, which is the bid, we can't get any money for it. No one's willing to pay us anything for it. If you sell a put, this is the bid right here. You can collect $39.14, but you're betting it'll be higher than 235. So Shaolin Monk is betting it'll be below 235. That's why he wants to buy this. Okay, now buy single, right? So look, if you buy, this is not a trade I'd recommend. Well, I mean, you could. I mean, the most you can lose is your whatever you pay for it, right? So the most you can lose is $4,000, right? Because times this by 100, right, per 100 shares. So if this sucker ends up being above that, you're gonna have to come out of your pocket, and you have to buy those at that price and sell them back to that guy, and you're gonna lose money. So anyway, that's to answer your question. That's why Doe is so good. If you're bearish and you want to buy something, you're better off because of the price here. Watch. Let's go. I don't know. Let's just look. Let's go to long. You want to buy a put. So let's go to long put, go like this. I'm just gonna play it right here for you here. Yeah, here you go. You could do it right here. Well, let's change the expiration to January like you wanted. Okay, done. So you're better off. See, you don't have to pay $6.34 here. Okay, and you know what I mean. But what you're saying is you're betting that the S&P 500 will be lower than it is right now. So if you buy it closer to at the money, and you're still in the money here because right we're below 197. Okay, the most you're gonna pay is $6.34 per contract. Each contract has 100 shares, so the most you can lose is $634. Okay, how much you can make is unlimited depending how far it drops. Okay, now according to the math, you have a 36% chance of making money. I mean, or breaking even, or making at least a penny. Look at your break even on. Now your break even is only the price of the SPY has to be less than 190.66. So for you to make any money, it has to be below $190.66. Now, if you're that bearish, this is why you should go sell or buy something closer to at the money. All right. The other thing you got to worry about too is for you to make money when you buy a put or buy any option, IV rank has to increase. Okay, so let me clean this up a little bit here. Let's go to this. Let's go to my clean chart right here. And there we go. So what you're doing is you're betting that by somewhere over here, you're betting that, of course, SPY will be lower than it is now, but also IV rank has to be higher than it is now when you place a trade for you to make any money. So up to you what you want to do. But your questions are right on. I don't know why it's so expensive. Well, I do know why it's so expensive because the probability of that happening is so high. You know that you know what I mean. That's why you have to pay so much because I don't know who else would. No, I don't know who else would want to sell that to you because they have a high probability of being wrong. I mean, you know what I mean. So anyway, so that's that. I hope that answers your questions. Nothing much has changed for the outlook. I'll do a quick update here. I got 2 minutes left. Let's go to the ES because that's the futures market. I didn't even look. It's Sunday today. Here we go. Here it's loading up. Okay, so as you can see, here's the ES. This is the 27th, which is today. It's up a little bit. It's basically even. Let's go to the 15-minute chart right here. Yeah, let's go after hours here. Yeah, so here's where we ended on Friday, and here's after hours. So we're basically flat. It went up a little bit. So now, if you're watching, what you want to do is you want to watch these after hours prices. If during the regular trading session it breaks up above our high in after hours or pre-market, look for it to go higher. It has to do that for it to be a solid higher. For example, here we go. So for example, here's Thursday, right? Ended down here, and then here's Friday after hours Thursday, and then here's Friday morning, right? So look at the high. The high was around here, right? It opened up higher than that, okay? So of course, once a tick on their 50-minute chart, once a tick finishes on that, it's usually a bullish sign, which is kind of what happened. So anyway, that's where we're at. So for as far as mine goes, I want us to finish above 190 this week, and me personally, and after that, I kind of wanted to drop a little bit because I kind of wanted to finish around that 188, 189 area. We're at 196 on the 1960 on the ES. On the SPY, we are at, whoops. So this week, for me to, the ideal situation for me is we finish above 190 this week, all right, October 31st sometime. So we've got about a few days here. And after that, I wouldn't mind it dropping a little bit for my positions. But anyway, like I said, golden geckos, you just kind of want a neutral thing. So like I said, I kind of wanted to hover around this middle Bolin band, around the middle. This is the high, this is the low. This dotted cyan line right here, or really where that 21-day moving average is. I kind of wanted to hover around there because that's right around 193. I kind of wanted to finish actually lower than that, kind of right around this 233-day moving average actually. Anyway, so we shall see. All right, I hope that helps. Give me a shout out if you have any questions, and hey, share the wealth. Let people know if you like what you see here. Thanks a lot.